Hello and welcome to The Exchange. I'm Julia Chang. Let's take a look at what the experts recommend and how companies are facing the challenge of managing risk in financial services. And finally, suggestions by our experts on how businesses can proactively manage risk and turn risk into reward.
The ability to take risk is essential for being ahead.
I think the challenge is with any sort of risk measurement, risk guidance system, is you get comfortable with it.
Our job is to really stay forward-looking in their management of operational risk.
It's really thinking about it in terms of what the impact it can have on the strategy and the direction of a company as a whole. And it needs to be aligned with the overall corporate objectives to truly be effective.
Managing risk has become a complicated and all-consuming issue for financial services firms today. Just consider the facts.
When you think about operational risk in the larger sense, and you think of it as really impacting a firm's reputation, its relationship with its clients and its major shareholders, then you really have to come to the conclusion that it is a C-level activity. When you talk about improving business processes, improving client relationships, and ultimately improving the whole process of managing a company's brand and name, it's really, really difficult to quantify that.
Everybody has to be on the same page for that. If everybody's taking their own risks, it doesn't work. That's why you need some sort of enterprise-wide culture, and it's got to be transparent. It's got to be simple. It's got to be shared by shareholders, by management, by employees, by all the other constituents that make up a modern company.
The management of analytical reporting, data metrics, and the monitoring and tracking of business processes, people, and capital is critical to risk management.
I think what we're trying to do is capture the risks. We're trying to be able to measure the risks. And we're trying to quantify where the risks are, what they look like, how they impact the businesses. And trying to give the businesses a set of tools where they can measure and manage the risk within the business activity.
Again, since the operational risk category is so broad in its definition, it's really important to organize yourself well and scale the effort using technology so that it's not a manual process in terms of what we're going to track, how we're going to report it, and so you begin to organize yourself so the standards can be applied across the firm, and that way you can have a better process for understanding data on an organized and disciplined basis across a large and diverse firm. Today we have 37 banks from both North America and Europe predominantly. We have very strong growth rates, obviously, in the last couple years of members, and we now have over 65,000 data points in the database. So the data is robust. The standards for integrity of the data are pretty strict, so we're confident that we're getting good information. And now we're very pleased to be announcing a partnership with IBM in which the analytic team of IBM Research in Zurich is going to have access to the data and really be able for the first time apply that experience, capability, and resource to this data.
This has become big business for financial services firms today. Despite the potentially overwhelming nature of all forms of risk, firms have the opportunity to turn risk into reward. For example, Tony Peccia of Citigroup recommends how companies should approach operational risk management
in a way that allows us to improve the performance of the businesses, improve the allocation of capital, get away from the control mentality of this is all about better controls to this is really about better risk management, which means making trade-offs between here's a risk, do I understand the risk, how much am I getting paid to take on that risk, is it sufficient for the amount of capital I need to support that risk. All banks should look at this and say, what value can I generate from this regulatory requirement? If you just do it as a regulatory exercise, it'll be a lot of cost and you'll meet your regulatory requirement, but there'll be actually very little benefit to the bank.
As we wrap it up, so what do you think about the issues? Tell us what you think and post your comments to the Financial Services video blog.